All right, good morning, my finance warriors. Welcome back to our study group sessions with the American Institute of Finance. Again, my name is Chris Manfre. I'm a lead instructor at the Institute, and it's my pleasure to have you back. Let's just wait one moment to make sure that everybody's joining in. All right, so welcome back again. It's nice to have you back. So today we're going to continue our discussion about options. So you might recall last session we talked about options a little bit, but I realized that I did not cover everything that I wanted to cover. So I want to dedicate this study session to talking more about options. So just to recap a little bit what we talked about last time. So very briefly, so options were created in the 70s, and they can be used for many different reasons. And so they can be used for investing, for trading, another word for speculation, but they can also be used for insurance, right? So today what I want to do is to, again, recap a little bit about the use of call options, put options, but also practically show you an option chain to see how it works in reality. And finally, I want to talk about the Black-Scholes option pricing model, so you have an understanding on how we actually price options. And then if we have time, we'll briefly talk about the Greeks, okay? All right, so moving on. Option types, again, as I mentioned last time, basically there are two types of options, and it's very important to master these options before you move on with other types of derivatives, right? Because derivatives can become complex very, very quickly. So it's important that you actually really understand and master the basics, okay? So call options, put options, as you can see in the little icon picture there, we got call going up and put going down. So something that I will repeat during this session is that you have to remember that when you buy a call, basically you have your point of view is that the stock market very likely will go up, right? And when you buy a put, actually you're bearish on the market. You're thinking that the market very likely will go down. Now, we don't know if we're going to be right or wrong, but when we invest or trade or insure ourselves, we must have a view, right? So don't forget that. It doesn't mean that your view is right or wrong, but you have to have a view. What I also mentioned last time, I'll mention it again briefly, it's that this is a zero-sum game, right? So basically what the buyer and the seller of the what the buyer of the put gains, the seller actually loses. So that's what we refer to as a zero-sum game. So option inputs, so that before I show you the examples, you actually understand what the inputs of an option actually are. So we have the underlying price of the stock. This is a very important input, of course, for options. So you look at the stock. And again, not every stock has options available in the marketplace, right? But for some of the biggest companies out there, obviously, right, Tesla, Google, McDonald's, etc., you might find options, okay? So the underlying price of the stock is a very important input for options. And by the way, it's great to talk about options because if you see what happened recently, by the way, there is a lot of trading in options, right? Which somebody claims is the reason for why the market has been going up so much recently, and it might be also very volatile at times. So it's good to keep an eye on options. So we talked about the underlying price of the stock. The next input is the strike price. Okay, so I will refer to the strike price many times during this session. So the strike price is the exercise price, basically what you pay, right, for the underlying stock when the option is actually exercised. Then we have the expiration. So these contracts, these options contracts actually expire, and they can expire in 1 day, in 1 week, in 1 month, in 1 year, or even in 2 years, okay? So the expiration is actually very important because it drives value for the option. And then we have the premium. The premium is what you actually pay to buy this contract, right? And so we refer to it as the premium, or sometimes it can be also the value of the option. Okay, so we talked about a call option and a put option, and I said it's very important that we understand the basics. So a call option, as I mentioned last time, gives the owner the right, but not the obligation, and this is really key, right? Not the obligation, but gives the right to the holder or the buyer of the option to buy 1 share of stock from the issuer of the call. Okay. Also, please look at the lingo. So we say owner of the option, holder of the option, going long the option. That means buying the option. It means that you bought the contract, right? So it gives you the right, but not the obligation. Now, when you exercise the option, you're actually going to buy the underlying stock at the strike price. Okay. So the owner will only exercise the option if the stock price is above the exercise price. Let me say that again. It must be that the stock has been going up. The price per share of the stock that you selected for your option has been going up above the strike price. Otherwise, it wouldn't make sense for you to actually exercise the option. Okay. So moving on to the next slide. Remember, there is a seller on the other side, right? So the seller of the call option will sell the contract to the buyer, and the only thing that they will receive at that time is actually the premium, right? You might say, well, why would they get into this type of transaction? Well, the seller of the call option must have a different view from your view, right? I told you that it is important to understand your view. So in this case, the seller of the call option must believe that the price of the underlying stock will not actually move, or it will go down, right? So it must be that the seller of the call option contract thinks bearishly, so to speak, about the underlying stock, okay? Also, very briefly, and it can become a little bit more complicated, but remember that selling a call option can be done in 2 different ways. It can be covered or it can be naked, okay? And this is also part of the lingo of dealing with options. So covered means that the seller of the call option actually has the underlying stock, right? And naked, it means that the seller of the call option is selling the stock naked, meaning without having the underlying stock, right? It transpires clearly that selling options and naked can be a lot riskier, right? And I'm not going to explain today why, but I will invite you to investigate and understand the differences between selling a cover call or a naked call. And there you go. This is an example for a call. So an investor buys a call for ABC Inc. trading at $10 per share. Okay. So let's say you are the buyer of the call. So you buy the call. The price right now is $10 per share, and you pay 50 cents for the premium. Okay. And the strike price is $12 per share. Again, so currently the price is 10. The strike is at 12, right? Is at 12. So now, let's say that the price goes to $14 per share. Well, that's great news for you, because now you can basically buy those shares for just $12, right? For just $12, while the actual price is $14. So that means that you will make $2 per share. But not so quick, because you actually paid 50 cents for the right to actually do so. So you will have to subtract those 50 cents from your profit. And so this is what you can see here. You do $2 minus the 50 cents that you paid, and this is per share, right? And you will receive $1.50, right? The seller actually loses the $1.50, because I told you this is a sum game, right? So basically what you gain must be the loss to the writer of the call, okay? All right, so now let's see case number 2. Let's say that the price actually drops to $8 per share. So the options very likely will not exercised, right? Because it doesn't make sense to do so. If you want to buy shares in the marketplace, you can just simply go and buy shares for $8 per share. So you would not spend $12 per share. It wouldn't make sense. So in case 2, basically the call option will expire unexercised. So moving to the next slide. Okay, when you study options, you will see the payoff diagram, sorry. And it's important that you familiarize with these types of diagrams, because when you start putting together different strategies, for example, that entail both puts and calls, right, the payoff diagram can become very complex very quickly. So it is important to master the basics, right? So what you see in this particular diagram, basically going on the x-axis here, it is the price of the stock, right? So that means that this is the strike price here. So in a previous example, all right, this would have been $12 per share. And so you can see that basically you, as the buyer of the call, you would not make any money, right, in this area here until you get to $12. If the price keeps going up, right, now you start making money. Now you start making money, and how much money you make is actually measured on the y-axis, right? So the more the stock goes up, and going up is actually indicated by the x-axis. Don't get confused, right? You might say going up must be on the vertical axis. No, it's not. It's actually on the horizontal axis. This is where sometimes you might get confused. And so if the price of the underlying stock goes beyond this strike price, now you see that this line is upward sloping, so you start making money, right? This is for the buyer or the holder of the call. Conversely, you can see that this diagram is for the seller of the call. So I told you it's a zero-sum game. What the buyer gains, the seller loses. So if the price goes up, right, if the price keeps going up, now the seller of the call starts losing money. And again, this was, in our example, was our strike at $12 per share, right? And so that is basically what happens. All right, so let's talk briefly about the put option, right? The buyer of the put option. So again, if you buy a put option, you're actually going a different direction. You think that the stock price will go down, right? So you gain the right, you buy the right to sell the stock at the particular price. So in this situation, it is important to understand that very likely you actually have the underlying stock, and you're buying the ability to sell it at the one particular price. So you might think that the price is going to go down, and you want to buy the right to sell the stock at the price that you find to be good for you, based on your strategy, based on your view of the market, right? So the exercise price or the strike price is the price the owner of the option can receive for selling the shares. Similarly to the call option, the writer of the put option will just simply receive the premium, okay? And again, similarly, it must be that the writer of the put option has a different view about the market. So very likely the writer will think that the price either will not move much or the price will tend to go up. Now let's look at a put example. An investor buys put of ABC and is trading at $10 per share, so the same as before. The underlying price, therefore, is $10 per share. The buyer of the option pays 50 cents to buy the options, and the strike price is $8 per share. So now you see that the strike price is below right, the underlying price of the stock. So let's see case one. So the price goes to $6 per share. So the option buyer at this point can gain. Why? Because if you bought this option, you can sell the shares for $8 per share, right? They went down to 6, but you can sell it for 8. You see? So now you're making money. You're making the difference between 6 and 8, right? 6 and 8, which is $2. Not so quick. You paid 50 cents, right, for the right to do so, and so you're collecting $1.50. Now the option seller has to pay $8, right, for something that can be actually bought for $6 in the marketplace. So now you see that the option seller is actually losing, right, losing what you are gaining. Okay, so you can see the different view in this case, right? The buyer of the put anticipated that the price per share would actually drop, and he or she is trying to benefit from it. Now let's look at case two. Case two, the price actually rises to $12 per share. Well, in this case, you can anticipate that the option is not going to be exercised, right? It is not going to be exercised. So the option buyer loses the 50 cents, and the option seller actually gains the premium. So similarly to the call options, we have a diagram for the put option. So you can see this one is for the holder or the buyer of the put. So when the you can see that if the price keeps going up, the buyer of the put is not going to make any money, right? You need the market to go down. You need the price per share of your selected stock to go down below the strike price, right? Below the strike price, and at that point, I think it was $8, right, in our example. So at that point, you will start making money. Again, this is the payoff diagram for the holder or the buyer of the put. And this one is the diagram for the writer of the put. So you can see what happens here, right? If the price actually drops, goes below the strike price, like in our example, the strike was $8 per share, and it went, in case one, it went to $6 per share. Well, right now, the writer of the put starts losing money because you see this is 0. And on the vertical axis, you're measuring the payoff, and in this case, for the writer of the put is not good news. You are actually, the writer is losing money. Okay, what we did not absolutely say last time, and I wanted to clarify this, is that to value in options, we use 5 ingredients. Okay, and this is always true. So the 5 elements that determine the value of an option are illustrated in this slide. And so again, we have the price of the underlying asset, which is a stock in this particular examples that I gave you, the strike price, the time, the interest rate, and the volatility of the asset price. Again, the price of the stock, the strike or exercise price, when the contract will expire, the interest rates, so the economic environment will determine what the interest rates actually are at that point in time, and how volatile the underlying asset actually is. Okay, so by using these 5 ingredients, we basically can determine what the premium, the theoretical premium of buying an option could be, right, or should be. Now, we typically use the so-called Black-Scholes formula, right? And again, this was created by Professor Black and Professor Scholes during the 70s, and this formula allows us to calculate the theoretical premium of a stock option. Let's go to I want to show you this in practical terms by working on a Excel sheet. So let's go to the Excel sheet where I can show you how this actually works. Okay, so let's see. Okay, so here we have the Black-Scholes option pricing formula. I'm not going to dive into the mathematics of it. It can be fairly complex, but what I want to show you is that it is not complex to actually use the formula itself, and it can give you an idea on how options are actually priced or valued. So here for S we mean the price of the underlying stock. For X we have the strike price. For R we have the interest rates. For capital T we mean time, right? Time to expiration, when the option is going to actually expire. And then for sigma we have the volatility. Now, what I would like to do with you is to actually try to price an option here today in real time with you guys. So I want to go to the website where I have my option chain. Okay, so there you go. You can see we have an option chain here. This is from my personal account. So what you can see on the left hand side is different expiration dates. And I briefly mentioned this to you last time. And so let's say that we want to look at an option that expires next Friday. Let's assume that today's Friday, it's already Sunday, but let's say we were doing this on Friday, right? And we have this particular option expiring 1 week from now, so September 11, 2020. So let's see. The price was approximately 342 for SPY. Again, this is for the S&P 500, right? For the S&P 500, and the price at closing was approximately 342, and it was approximately 342. So let's say that at that particular point in time, we are going to buy a call, for example, right? So you can see that in this chart here, let me see if I can scribble on it. So you can see that there is a divide, right? There is a divide between, let's see if I can scribble on it. Okay, so the color is different. It doesn't let me write, but that's fine. The color is different. You can see that you see 342 for the strike. That's because the color changes here between 342 and 343. That's because the price at that time was very close to 342. So let's say we're going to buy a call with the strike of 345, okay? And you can see that if we bought a call at that time, we should have paid approximately $3.09 per share. Look at that, right? $3.09 per share. So let's go back to the Excel sheet, and let's see if we can replicate this with a theoretical form. Okay. Okay, so let's write here. So the price was approximately 342. The strike price we wanted was 345. Now the interest rate for 4 weeks is 0.10%, and I know this because I already looked into it. But if we want to do it for a week, we got to divide by 4. So that would be the interest rate for 1 week. Now 1 week would be 1 over a total of 52 weeks. And we know that the volatility of SPY is approximately 18%, typically, over long periods of time. All right. This is interesting because, as you can see down below here in yellow, we had a theoretical price for the call, right, of $2.13, right? Can you see that? I'm going to actually make it of a different color, 213. And again, we filled out all these cells here. I'm gonna make it orange, right? Again, the price of the underlying stock, which is the SPY ETF, which was on Friday at closing 342. We have the exercise price that we selected at 345. Then we have the interest rate for a week, right? The time is 1 week because it will expire next Friday, so it's a very short period of time. And then we have a theoretical sigma volatility of 18%. The price that we observe here, based on the calculation, based on the Black-Scholes option pricing formula, is actually $2.13. You see there is no difference between bid and ask in this particular case. There was a slight difference in the option chain that we just looked at together, but you can see that we're below the approximate $3 value for the call. I would say though that last week, during the last couple of weeks, volatility has been up. So if 18%, for example, is an appropriate volatility for, let's say, analyzing 10 years worth of data, 20 years worth of data, the anticipated volatility probably could be higher at this point based on what's going on in the market. So if we, just for fun, we change this volatility, I'm going to change it to 20% instead of 18%. Now you can see that the price is going up. Right now we're at $2.49, right? And if I increase it even further, right now we're at $3.40. So I might want to shave it a little bit. So let's say 22%, right? Or 23%. So I'm going by trial and error. And you can see that now we're at $3.03. So we're very, very close. And we know that the volatility was high last week. So this is to justify the price that you could see in the option chain, right, at the end of Friday last week. Okay, so you can see that this formula can be very helpful in understanding the price of the option, both for the call and the put. And I think I didn't look at the put, but if you look at the put, the price is actually very close to $6 in the option chain that I showed you before. In fact, I want to prove that to you. Let's go back to that. Also make it green. So the put price, it would be in the money, by the way. So yes, you can see the price is actually between $6.05 and $6.23. So our Black-Scholes formula is doing a pretty good job, right, at figuring out the premium of the options. Okay. All right. We don't have a lot of time left. Let me go back to the original presentation. Can any? I see there is a question. Can anyone sell naked options? I would say no. Okay, you cannot do that, and if in your normal cash account you cannot actually sell naked options, and so for that you need a specific approval from your brokerage account, from your broker, right? And so make sure if you want to do this, try to educate yourself as much as possible. You know, study as much as possible. Open your account first, a cash account, and then open a margin account, and then you can apply typically to your brokerage firm for trading naked options. It is important that you know, even your brokerage account has at heart your best interest in that sense. They don't want you to hurt yourself, and so there you go. They want to make sure that you know what you're actually doing. Okay. All right. So I just wanted to say we don't have a lot of time left. Let me just briefly mention the Greeks, and then you can go and look at it yourself, right? Sometimes when we talk about options, or very often when we talk about options, we talk about the Greeks, right? What are the Greeks? So these are metrics, parameters that can help you trade with confidence options. And I'm just going to mention what they are. So we have delta, we have gamma, we have theta, we have vega, which by the way is not really a Greek letter, right? And then we have rho. So delta tells you how much the price of the option changes for $1 change in price. So you can anticipate based on delta the direction of the value of the option when the price changes, the underlying price changes. Gamma is the rate of change in delta, and it's a little bit more complex because it involves a little bit of calculus here, right? It would be the first derivative of delta basically, or the second derivative of the price. So you see, the math gets a little bit more complex. Then we have theta, which is the time decay on the value of an option. And vega indicates the sensitivity of the price of the option to volatility, to the volatility of the underlying stock, right? So what happens when the volatility increases? Very likely the price of the option is going to increase. And finally, rho is going to indicate the change in the value of the option based on how interest rates are changing. All right, guys. Well, we covered a lot of ground in only 30 minutes. I'm very proud of you. And well, thank you for attending. Have a wonderful long weekend, and I will see you next time.